I wanted to talk about the interview I had with the one and only Brandon Turner. Brandon Turner was a great conversation. I personally got to put to bed a lot of past hard feelings, which was very cleansing for me. But really during that conversation, one part of that stood out. I have gotten multiple messages over the last week from folks basically asking what the heck happened. In fact, I did an interview with Taylor from Life Goal Investments this week talking about how the heck can real estate values go to zero. Now, of course, we are talking about equity, not the entire value. But during the discussion with Brandon Turner, he highlighted that he personally is invested in 3 syndications as an LP. These are not deals that he's a GP on. Again, I want to be very clear. He is simply an LP. And during that conversation, he highlighted that 2 of them are going to zero. And the third one, he's hopeful to get 50% of his money back. Obviously, we talk with the one and only and great Jonathan Twomley each week for the last 3 or 4 years. He is not, he got out early. But yes, it is going to be interesting to really riff on how this happened. How can very knowledgeable and experienced people like Brandon Turner lose all of his equity? What do you think, Jonathan? This pain is starting to be recognized.
Yeah, well, I mean, I can tell you sort of from my own experience how it happens, because I'm also involved in a deal that is not doing well. And the way I think I haven't seen the interview with Brandon, so I don't know, but I can tell you sort of in my own experience, holding out, waiting for the market to correct. The correction's coming, the market's climbing, it's getting more and more risky. And then at some point you're like, well, you know what? Maybe all these people are smarter than me. Maybe they know something I don't know. Maybe when they're talking about forward yield curves and all the stuff that I frankly pay zero attention to, because I would never do variable rate debt. So it doesn't the forward curve doesn't matter to me. Right. But maybe when you have people who have like a CFA and they're very financially sophisticated and they're talking about the SOFR curve and the forward yield curve and all this kind of stuff. And you're like, okay, well, maybe they know something I don't know, or maybe they're right. Yeah. Maybe this is just going to continue forever. I think it's very hard to resist that forever because at some point you're like, is it ever going to end? Am I ever going to be able to put my money to work? And, but when that happens, I mean, lesson for the future, like, lesson for all of you. If when Jonathan Twomley throws in the towel and invests after he's called the top, then take your money out, right? Like that's the time to sell.
Yeah.
Because I'm the last holdout. I'm the guy who capitulates. Yeah. Right. So,
it's funny that again, I love the fact that you and I have been doing this, I think almost 5 years now. And both of us sold a lot of our portfolio in 2018 and 19, at least apartments. Yeah. Because I thought prices were crazy. And as it turns out, I sold early, right? If I would have held 2 more years, probably would have been multiple 7 figures in increased equity. But to your point, it was all fake. It was all not real.
Right. I mean, listen, we can't, yes, from a very technical point of view, yes, if we had waited longer, we would have made more money. But nobody could have predicted COVID, right? That was a black swan event. And all indications were that the market was starting to kind of top out, because absent the Fed lowering interest rates, there was really nowhere else for it to go, right? For the market to go. I mean, it could continue to kind of trend up, but the supply, all the supply that came online in the last couple of years, that didn't start after COVID, right? That all got started before COVID. All that stuff was coming. Yeah. So I think, we couldn't predict COVID, but I think absent COVID, we would have been right on the money about when we sold. And, so we held out. If you'd waited a couple of years, we would have made more money. But I'll tell you one thing, not a single one of my investors was upset about the checks that I sent them when we sold, right? They were all very happy.
I agree.
Yeah. So, I agree. Yeah. So we took a profit when we took a profit, and it's great. But here's the thing. You can always look back in hindsight and criticize yourself for like, oh, my timing could have been better, but you make the best decision you can at the time. And it's better. It's always and what we're seeing now is it is always better to sell too early than to sell too late, right?
Yes, thank you. That is a great quote. Yes.
Yeah. If you sell too early, well, all you're missing is opportunity cost. If you sell too late, then, well, if you don't have the cushion to carry you through to the next cycle, then you risk losing everything. And what happened is people who bought at the top, or as we'll talk about in a minute, worse, 1031 at the top, right? In order to get those deals, they had to overpay. Plus they had to put, and the only way they could overpay was to put funky debt on it, put really risky debt structures on it with pref equity and all these other things. They just set themselves up for really anything going wrong was gonna send the whole thing crashing to the ground. It was a house of cards.
Yeah, these deals were the ultimate price for perfection with ridiculous assumptions that had to go right for these to pencil. But when we step about the topic at hand, right? Brandon Turner is a well-known real estate investor. I would call him a very sophisticated investor. I think he's a part of 10,000 units. I think somebody told me. So he's no slouch. So when you think about somebody like Brandon Turner getting into 3 funds, 2 go to 0, 1 gets cut in half, you got to ask yourself, how does that happen? And I think it happens simply because momentum. I think this is simply that momentum. And because what happened is some people got in early in 21, remodeled 10% of their units and sold for a stupid price, getting everybody's money back. And they're like, dude, do it again, do it again, do it again. And I think it just becomes almost this casino-like behavior where the masses get around the craps table because somebody's on a hot streak, and then bingo bango, you roll craps and everybody loses.
Yeah, I mean, momentum is a big part of it. FOMO is a big part of it. And one of the things that I always really react against, but you see lots of people justifying their behavior based on what they see some big player doing, because they assume that, oh, well, this guy has 10,000 units and he just invested. So, well, he's smarter than me because he has 10,000 units. So he must know something. Or I've already decided to do what I want to do, but I see Brandon Turner doing it. So therefore I feel like it's safe. And then everybody's kind of looking around at each other, seeing what everybody else is doing and deciding it's safe because everybody else is doing it. And you get this kind of like herd mentality that, that just carries everybody forward. And then there's also the fear of missing out. You don't want to feel stupid. And frankly, I mean, listen, I felt really dumb for a long time when people around me were like just making money hand over fist,
printing money
as they rode the wave. And I'm like saying, hey, wait a minute, everything is overvalued. None of this makes sense to me. It feels super risky, but everyone there, but it's like, hey, Jonathan, we're making money and you're not. Like, you feel like an idiot after a while. Right. So that's a very strong.
I got to imagine. Yeah. It's really funny, folks. Again, I want you to remember this video because over the last couple of years, you've seen me, quote unquote, feel like an idiot a couple of times. And I'll remind you what those were. First, it was the multifamily game, right? I sold in 19 and, there was a lot of people, making money 21, 22, 23. But I want to remind you of another one, the Airbnb craze. Remember the Airbnb craze? I told you guys all about this. I was being called a boomer. I'm not a boomer because I was simply a long-term lease month-to-month guy. And they were, saying that I could triple my money, and I was being clowned on by these short-term operators. And again, anytime I see the lemmings rush one direction, I have a visceral reaction to go the other way because I know it will feel good for the moment, but I can tell you how that party ends. I've seen it a dozen times in real estate. You guys need to pay attention. When everybody says you can't go wrong, oh, yes, you can. Real estate has taught us that many times.
When everybody's doing that, like that was why I was always reluctant to invest in Texas from the very beginning, because not that Texas isn't a good market and not that the demographics are fake, but the thing is, it's possible to take like great demographics and make it a bad deal if enough people are in the trade.
Sure.
And that's what I was seeing too many people rushing to Texas in a really unthinking, simplistic manner, essentially saying like, oh, it's in Texas, it's good. Right. And that kind of, behavior leads to, rents declining 15% in Austin because of overbuilding. Right. And so, So yeah, what you said is right. When everybody is doing something, think about it really critically, whether you want to do it. When everybody's telling you stuff like interest rates can't go down, rents can't go down, right? When you start hearing a lot of people say that, you should basically take that as a signal that probably interest rates are about to go up and rents are about to go down. The crowd usually is
Yeah.
is over. I wouldn't say the crowd is wrong. I think the crowd overextends itself. It becomes very easy for that momentum to build up and for the crowd to just get out over its skis. Opposite signal is if everybody tells you shouldn't do something, you should probably take a good look at it, because every single listen, people are making money in every single market out there, right? And if people are telling you you shouldn't invest in this state, you shouldn't invest in this city, you shouldn't do this, you shouldn't do that, and then you look around and you go, but what about all those people over there? What are they doing?
Yeah.
Right? They're making
Yeah.
money, right? So you should definitely, when the crowd is telling you not to do something, that's also probably a signal that it might actually be a really good time to look at it hard.
Yeah, I totally agree with that. Well, let's go back to something you brought up earlier, which I don't want to miss because I think a lot of people need to remember this next time, is the whole fact that a lot of people kind of kept their chips on the table, right? Using the craps analogy, you didn't take any of your profits, you just kept stacking. And a lot of people exited deals with 1031 money, exited monster wins. Let's be very clear. These were super duper grand slam home runs. And instead of paying the taxes, because again, there's a mantra that says thou shalt never pay taxes, they rolled all of their money into the next deal and the next deal. And if you're doing that into a market that is momentum based, frankly, you're guaranteed to lose. It may not be on this bet. It might be the next bet or the next bet. It's a bad strategy. Paying taxes is okay. You never go broke taking a profit.
Exactly. And I think, I've been thinking about this issue a lot recently, because I realized something that, people talk about sort of risk factors, right? And obviously, I think everybody knows putting too much debt on a property is a risk factor. It doesn't stop people from doing it, but people put too much debt on a property. I realized that 1031 is a loss multiplier, right? Now, what do I mean?
Yes.
What do I mean by that? So now, most people seem to use 1031 in what I think is really like a backwards way. They sell at the absolute top of the market, right? Or where they try to sell at the top of the market, and then they're buying into a very hot market where it's very hard to get good deals, right? And so they're overpaying. And if they then layer a funky debt structure on top of overpaying for the deal, here's where 1031 becomes actually a loss multiplier. Because what happens is, if that second deal goes down, right, not only do you lose your profit, not only do you lose your equity, you still might wind up with recapture tax to pay, right? Because, and especially if people did what I saw a lot of, is on that second leg of the 1031, they also did bonus depreciation, right? So they reduced their basis by a ton. So now at your foreclosure sale price, even though all the equity is wiped out and maybe some of the debt also, you still have a gain, right? You have, because your basis was taken down to zero. People are doing really dumb stuff with trying to game the tax system without thinking about the implications of it. And the way that these things, bonus depreciation and 1031, should be used by very sophisticated investors. And the way that I see them using them, so 1031, for example, the really sophisticated people, right, are selling now, or maybe when the market is a little more liquid, right? So it's hard to find the down leg deal now because the market's so thin. But when the market starts to pick up a little bit, what the really sophisticated people will do is they're going to take that property that they've owned for 10 or 20 years, right, that has a lot of built up, gain, right, because they've depreciated a lot, but also just because the market has gone up. They're going to take that and now move that into a higher quality asset through 1031 when they are not in a situation of having to overpay. They're doing the opposite of what most people are doing, which is like selling deal A for top dollar and then struggling to find, then an overpaying for the second deal.
Yeah.
These people are, maybe they're leaving some money on the table for the first deal, but they're planning ahead because they're getting a bargain on the second deal. It's a much better way to do it. And then as far as bonus depreciation is concerned, that's fine. Like bonus depreciation works if if basically you're an owner who never sells, you just buy, right? Because then you're strategically timing your sales and you can't do a 1031. So you buy another asset and you use the bonus depreciation to wipe out the taxes. But basically you are a long-term holder who's not really ever planning to sell. Then it makes sense. If you are an LP in a syndication that's going to be flipping in 3 to 5 years and you keep on doing 1031 and you keep on doing bonus depreciation, if you get caught short, which is what a lot of people are doing right now, you're in a world of hurt. And
I want to go one step further. If that's your strategy, I guarantee you will eventually get hurt. Real estate, it runs in cycles.
Yeah.
So if you keep, flipping coins in their head, eventually you're going to get a tails and get wiped out. That's a loser strategy. Why would you do that? It's not a good idea.
Because, I know why people do it, because they're greedy and they're not thinking about these things. And what I used to have, so some of you may know this, but probably a lot of people don't. I used to have the biggest multifamily Facebook group on Facebook. Well, obviously it's a Facebook group, so it was on Facebook. I had the biggest multifamily group on Facebook. It was bigger than Bigger Pockets, bigger than anything else out there when I started it. And eventually, that kind of ran out of steam, but there were a lot of really great debates that would happen in that group. And one of the things that we were debating a lot around 2019 was whether you should be doing 1031s at the top of the market. And basically I said, look, listen, your scenario is exactly what's happening today, which is on that second leg, you may get wiped out because you're going to overpay. And it wasn't even at that time thinking about the funky debt structures that people wound up using in like 2022 to try to get deals. Even without those, they were setting themselves up for potential disaster. And man, I'll tell you, the blowback I got from the people who were like, you should never pay taxes. You're an idiot. You should, why would you not do 1031? You should always do 1031. It's like, well, no, you should not always do 1031. There are times when you're better off, you're better off paying the 20% capital gains tax, right? And now you've got all your original capital plus 80% of the gain to then sink into a new deal after the crash and buy a bargain.
Or multiple deals. Yeah.
Or multiple deals after the crash. So so what? So you pay 20% in tax, but now you're getting a 30% discount, right? Take that deal every day.
No,
so,
exactly.
Yeah.
Yeah. Again, I do think a lot of people do 1031 exchanges wrong because they do sell at the peak and they jump to the peak, which just guarantees pain. I did do 1031, what at least I consider correctly. I went from one asset type to a different asset type because different asset types behave differently. I went from houses to apartments.
Or you could go in with more equity, right? In the second deal, right? Just make it more conservative. But of course, that's not what people did. They pushed the leverage to try to get returns because these were syndication deals. Like if it was your own money, right? And you're like, I'm happy to like take a lower return for a while for the security, and then I'll refinance later. Like that's fine. But that's not what we saw going on. Right.
Absolutely. Well, Jonathan, you do an amazing job staying on top of this stuff. Where can people check you out, follow you?
Yeah. LinkedIn is the best place to find me now. So please hit me up on LinkedIn. I'm always happy to hear from people who are connected to this channel and can see what I post.
There you go. Thanks, buddy. I appreciate you.
Awesome. You too.